Ladies and gentlemen, good day and welcome to the Anupam Rasayan India Limited Q3 FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Kanav Khanna from EY Investor Relations. Thank you, and over to you, sir.
Thank you, and good evening, everyone. Welcome to Anupam Rasayan India Limited Q3 and 9-month earnings call. Please note that a copy of the disclosure is available on the investor section of the website as well as on the stock exchange. Anything said on this call which reflects the outlook towards the future or which could be construed as forward-looking statement must be reviewed in conjunction with the risk that the company faces. Please note that the audio of the earnings call is the copyright material of Anupam Rasayan and cannot be copied or rebroadcasted, attributed in the press or media without specific or written consent of the company. Today from the management side, we have with us Mr. Anand Desai, Managing Director, Mr. Gopal Agarwal, Chief Executive Officer, Mr. Amit Khurana, the Chief Financial Officer, and Mr. Vishal Thakkar, the Deputy Chief Financial Officer. With this, I would like to hand over the call to Mr. Anand Desai for his opening comments. Thank you, and over to you, sir.
Thank you, Kanav. Good evening, everyone, and a warm welcome to the Q3 FY25 earnings call of Anupam Rasayan. Let me begin by providing updates on our business verticals for the quarter. Our pharma and polymer segments, which serve as our new growth drivers, have continued to expand their contribution to our revenue. The pharma segment grew significantly, reaching 23% of sales, while the polymer segment accounted for 10% of sales in the 9 months of FY25. For the full year, we anticipate both segments to contribute meaningfully to overall revenue, with this growth trend expected to persist through FY26 also. As highlighted in our previous calls, the expansion of these verticals will help create a more balanced portfolio, ensuring greater stability against sector-specific fluctuations. Now let me highlight our financial performance for the quarter and half year under review. Our consolidated operating revenue for the quarter stood at rupees 390 crores, which was 32% higher than the Q3 FY24 and around 33% higher than Q2 FY25. This growth is, as discussed earlier, on the back of continued growth in pharma and polymer segments and robust performance by Transcripts. In the last 9 months, agrochemical sector has faced a weak demand situation, especially from Europe, which is expected to improve in coming quarters. On the margins front, consolidated EBITDA margins for Q3 FY25 stood at 31% on account of favorable product mix and strong margins posted by Transcripts also. Given the uptick in the demand momentum and projected offtake from our customers, we anticipate resuming our growth trajectory in the next financial year, targeting a 30-35% revenue increase in FY26. At Anupam Rasayan, we remain committed to building a sustainable business. Over the years, we have invested in various initiatives, including a recent 59 crore investment in a 9.2 megawatt hybrid power plant combining solar and wind energy, which was successfully commissioned in October 2024. With the agrochemical demand picking up coupled with higher contribution from pharma and polymer, and our growing strength in fluorescent chemistry, we at Anupam Rasayan are confident to get back to our growth path. With this, I would like to hand over the call to Mr. Gopal Agarwal, the CEO of our company, to discuss the business updates. Over to you, Gopal Bhai.
Thank you, Anand Bhai. Hello, good evening, all of you. I will begin briefly by discussing the business highlights, which will be followed by financial highlights by our CFO, Amit Bhai. As Anand Bhai mentioned, the challenges we faced in agro segment seem to be fading away, while the pharma and polymer segment continued to experience strong growth, driven by launch of over 17 molecules in FY24 and 6+ molecules that are being launched in FY25. It is also noteworthy that we have around 65 plus molecules of pharma and polymer in R&D and pilot stages currently. These 65 molecules can be split between pharma and polymer, say approx 30 and 35 respectively. All these molecules are going to be the driver of our growth in coming times. Apart from polymer and pharma portfolio, let me take this moment to talk about our other growth drivers. Our fluorination chemistry portfolio, which got strengthened with acquisition of Tenfac by ensuring uninterrupted supply of KF and HF around 3 years back, is continuing to see a good traction from our customers. As discussed in our previous call, we anticipate that Japan, where we have a very strong business development team, will contribute approximately 1/3 of Anupam sale for the next 2 to 3 years, with most of the business secured through long-term contracts. Further, I am happy to share that we have recently signed one contract and another LOI with a US MNC for supply of high-performance specialty chemicals used in critical polymer applications such as defense, electronics, and aerospace. With this and our new product pipeline, we expect US as a geography to have substantial contribution in growth of the company, translating to over 15% of sales over the next 2 to 3 years. The third driver of our growth, alongside polymer and pharma expansion and fluorination, is our continued capability to secure LOIs and successfully convert them into long-term contracts. At present, our order book stands at approximately 10,700 crores, spread across on an average 5 to 6 years. Of this 10,700 crores, 3,100 crore worth of order book is already commercialized, and of the rest, majority will be commercialized in FY26. Keeping all these growth drivers and initiative in mind, we believe that we should start seeing strong performance going forward. And as Anand Bhai already shared with you, that we expect to grow at a rate of 30 to 35% in FY26. With this, to take you through financial highlights, I would like to hand over the call to our CFO. Over to you, Amit Bhai.
Thank you, Gopal Bhai, and good evening, everyone. I'll start by highlighting the financial performance for the quarter before handing over the call to Vishal Bhai for in-depth discussion. Starting with our CAPEX update, as of December 31st, 2024, we have completed 650 crores of the planned 670 crores CAPEX. As Anand Bhai mentioned, all the plants are on track for commercialization by March 31st, 2025. As noted in Anand Bhai's opening remark, our new 9.2 hybrid project was commercialized in October 2024. This initiative is expected to generate annual energy cost savings of approximately 15 crores. Combined with our previous 68 crore investment in a 17.9 megawatt project, the total savings will amount to rupees 28 crores annually. With these efforts, 65% of the company's electricity needs will be met through green energy in the future. We remain committed to cost optimization and operational efficiency. This strategic focus, along with our ongoing expansion, positions us well for sustained growth. With that, I'll hand it over to our Deputy CFO, Vishal Bhai, for further insights into the financials.
Thank you, Amit. Good evening, everyone, and thank you for being with us today. I would like to share key performance highlights for the quarter and 9 months ended December 31st, 2024. Before we open the floor for Q&A session, I hope you have had the opportunity to review the detailed presentation and the results that we have submitted to the exchanges and posted on our website. Kindly note, our numbers for the quarter and 9 months are on consolidated basis, and they include Tenfac numbers as well. Let me first discuss consolidated financial highlights for the quarter ended December 31st, 2024. First, operating revenue for Q3 FY25 was at rupees 390 crores as compared to 296 crores in Q3 FY24, up 32% YOY. EBITDA, including other income, was at rupees 121 crores in Q3 FY25 as compared to rupees 81 crores in Q3 FY24, up 48% YOY. This would translate to 31% EBITDA margin in this quarter, up 389 basis points. Profit after tax was at 54 crores in Q3 FY25 as compared to rupees 26 crores in Q3 FY24, up 108% YOY. Our top 10 customers contributed to 63% of our total revenue in Q3 FY25. Talking about the 9 months financial, operating revenue for 9 months FY25 was at rupees 938 crores as compared to 1,000 crores and 1,074 crores in 9 months FY24, down 13% YOY. EBITDA including other income was at rupees 262 crores in 9 months FY25 as compared to rupees 306 crores in 9 months FY24, down 14% YOY. This would translate to a 27.8% EBITDA margin in this period. Profit after tax was at rupees 97 crores in 9 months FY25 as compared to rupees 127 crores in 9 months FY 2024. With this, we open the floor for Q&A. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone phone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Again, if you wish to register for a question, please press star and 1 now. Participants, you may press star and 1 to ask a question. Our first question comes from the line of Meet Vora from MK Global. Please go ahead.
Yeah, hi. Thanks for the opportunity. So firstly, while the pharma and polymers business is doing well, AgChem sales have been slow for quite some time now. So is this more customer specific or market specific rationalization in terms of overall sales?
Meet, thank you for that question. Let me answer it in this manner. Definitely, there was a bit of a headwind that we saw in the AgChem market, especially in the earlier year. However, if you look at also, there was one of the large Indian MNC in the agrichem sector, which was contributing around 15% of our revenue in the past historical numbers, which we have decided to withdraw our business from there. And that also has been one of the significant reasons why our AgChem contribution has been lower. So that's one that I would want to highlight over and above, because had that not been the thing, probably we would have been far better off, and probably a drop in AgChem would have been significantly lower, and our profitability or revenue growth would have been rather than a degrowth. Coming to how we see it from here on, we see that we have started seeing the strength, as what was mentioned in our opening remarks by Gopal and Anand as well. We see strengthening of the AgChem demand, especially also from Europe, and we anticipate that like in Q4 you would see a stronger numbers from the AgChem as well, which shall follow through in FY26 as well. I hope I've been able to answer your question. Me?
Yeah, sure, Vishal bhai. And so secondly, congrats on continuing the LOI signing and conversion of that into contracts. So again, like yesterday, we have signed a new LOI, and now based on that, what is your overall outlook for the US business?
Okay, so you rightly identified, Meet, that these two contracts are a very meaningful contracts for one contract and one LOI are very meaningful revenue drivers for us in the year. Yes, we expect both these contracts to be commercialized in next year itself, which would mean that we would have a significant revenue addition coming from these two contracts. And we expect that US as an end market would be in the high teens for us by the end of next year, or next year to 12 to 18 months time, which would be looking at high teens contribution from US. So if you look at from a geographical diversity point of view, if you really look at it, what has really happened to us is that agro is there. But if you look at personal care continues to be 10%. Then if you see pharma has become 25% for us. and polymer is more than 15% for us as we go. If you look at from a geography point of view, Europe, which was the largest market, today now we will have effectively four large markets, which is Europe, Japan, US, and India, and they all four will have a meaningful contribution to our revenue. In addition to Singapore, which will be also 15% as we move. So if you look at it over the last 3 to 4 years, where we have been very consciously working on our diversification strategy, you see that we have been able to diversify across products, across customers, across geography, across end market application, and also across the plants. Today we have multiple plants that from where we can cater to. So this strategy is just playing out, and as we move in next 12 to 24 months, this would have seen a far better balanced portfolio.
Sure, Vishal bhai. And in terms of reaching your peak revenue potential from the LY pipeline that has been signed, I think we were earlier envisaging that will be achieved broadly by FY27. So I think that timeline still remains, or is there any change on that?
So I think there we would expect that with the new LOIs and contracts also coming in, we feel that the peak revenue should be majority, the large part of the peak revenue should have come in by FY28. Because if you take us, the commercialization would have happened in 26-27, but the peak would come in by 28. And also, please appreciate that earlier we were talking about the numbers which were delivered in 2022 LOIs, which we were expecting for 24 to 26 to commercialize. Now we have other LOIs which are coming in 26, 24 also, and 25 as well. So which will also take a couple of years to commercialize and then ramp up. So it will be the case. I would put that. But to share, 3,100 crores worth of LOIs and contracts have been commercialized, and next year further a significant part of the balance portfolio should have also been commercialized.
Understood. Thanks for that. And just last question, are we also looking at any inorganic opportunities in this space, either on pharma, agro, or polymers, or within the existing verticals that we are having?
So honestly, see, we keep looking at any value-adding opportunities that we can have. Like what we did for TanFat, we keep continuing to look at assets and companies which are across geography. I think if it is agrochem, or if it's pharmaceutical, or it is polymer, as long as it's a value-adding and a strategically advantageous to us, we will be keen to look at it. And we continue to look at it as and when we have something very, very, very meaningful to share. We would definitely share with the market and with you and the team.
Got it. So thanks. That's all from my side. Best of luck for the coming quarters.
Thank you, mate. Thank you for that.
Thank you. Next question comes from the line of Harsh Shah from Axis Capital. Please go ahead.
Yeah, hi sir. Ankur Periwal this side. Thanks for the opportunity and congratulations for good set of numbers. First question on the changing business mix that you highlighted. So good to see personal care, pharma, polymers, etc. also improving there. So will it be fair to say that balance, here, which is roughly around AgChem, will be around 50-55% of the revenues in 9 months?
Yes, I think that's where it should be. And yeah, AgChem will be around 50-55%.
Great. And the margin profile for these segments, pharma or polymer, will it be largely the similar way, the way we have been pricing our AgChem, or these will be margin accretive?
So typically that how our business models are, where we try and look at a pass through from the margin side and cost side, but because these are also the forward integration and using our current value chain, our ability to get some extra margin is likely on this case. So both on polymer and pharma, we should have an upward bias on margin. And these are very niche applications, especially in polymer, which will ensure that our ability to asked for and retain that margin should be there. However, I would give a word of, I would be conservative and say that we should look at on a balanced portfolio side the kind of EBITDA margin that we have been seeing. But there should be an upward bias. I would always go with.
Sure, Vishal. So where I was coming from was, on a 9-month basis, our gross margin has expanded. And this expansion is largely led by this change in business mix. And given that incrementally also the growth horizon for polymer, pharma, etc. is pretty healthy, given the molecules that we are working on, largely these gross margins numbers should be maintained. Will that be a fair assumption?
Yeah, fairly similar. See, as you know, historically also I've been really suggesting that rather than looking at me from a gross margin, I would prefer to look at myself from a EBITDA perspective, because I have a contract or I have a business model where I'll ask for the pass through. So when gross margin is one of the factors, because if there is a complex product, then the gross margin will be very high, but my overheads will be also higher, and hence my EBITDA margins will be there. So seeing me from an EBITDA margin perspective would be a more reflective of my stability of my business. But you are right. Today, it seems to be the case.
Okay. So, Vishal bhai, one thing, since you mentioned EBITDA margins, are other overheads as well as manpower cost on a 9-month basis has declined, both in double-digit numbers. If you can put some more light here, is there a cost reallocation, or how should one look at it?
So I think this is also to do with two things. One is because of my lower volumes also has some bit of a contribution to that, and second also is the product mix. Because largely, if you look at it, my EBITDA margin has expanded. And yeah, when you look at my console, also please see that the 10-pack has really given a very high margin, and which is also getting to the console numbers moving on a different level, especially with the strong.
Sorry to interrupt. My questions were more on the standalone side. I'm excluding.
Okay, fine. Then let's take when you look at the standalone basis, I think the broad number that you're saying is largely on account of one, a bit of an ESOP expense which has dropped a bit, which is also the reason that you see this, and also a little bit of primarily bit of a volume part of it, which also means that there is a lesser job work that has gone out, and that is also one of the reasons. So two broad, if you were to see that.
Okay. And just lastly, on the working capital side, since the large domestic MNC is gradually exiting. Sorry, we are gradually exiting the large MNC. How should we look at the working capital part, both on ECM side as well as the new business, which is almost 50% of revenues now? How is the working capital? How are the working capital terms over there?
So you're right. See, it had the citrus variables been there in terms of, let's say, 2 years back when the market was more buoyant, then my working capital would have very strongly improved with this exit of the customer also, and also with the effort that we have put in. Because of the slowness that we saw for the last 4 quarters to 5 quarters, one, my debtors had expanded, which are now coming into a more stable, it's into the improving trend. And my inventory also, as my revenue now picks up, that should also start getting liquidated. I believe that the targets that we have kept for ourselves, I think the numbers we should be focusing on that, and 18 odd months plus 6 months, we should be there.
Okay, great. Thank you and all the best.
Thank you. Thank you, Ankur.
Thank you. Next question comes from S. Ramesh from Nirmal Bang Equities. Please go ahead.
Thank you very much, and congratulations on your results. So in terms of your operating cash flows for 9 months and this year, what is the capex you have done for these 9 months, and how are you seeing the operating cash flow, and what is the increase in debt as on date?
So okay, let me come to the first the capex part, and then I'll come back to the other parts. Just give me a minute, please. My capex for this year has been 200 crores, right?
Okay.
And if you look at my increase in my total today, my total debt level will be around 100 plus 300. So 1100 odd number will be my debt levels today.
Okay. And in terms of working capital days as of 9 months, where are we in terms of the inventory and debtors and the net working capital cycle?
So I would say that my working capital has been similar to what I have seen in the 6-month period. I would suggest you to take it at that level, and that's where I would put it.
So when you responded to the previous speaker that you expect to achieve reduction in working capital in 18 months, so what would be the net working capital number of days that you can achieve in the 18-month period?
That's what we've been saying, that 180, 200 days is the target that we are focusing, and that is the target we want to continue to focus on. So today, when you look at the days, what is happening largely is because of my first half, which was a muted half on a very lower numbers that I had. The days have expanded significantly when you divide it by the sales. But when you look at, let's say, if I were to even look at a revenue, let's say, of a 13 to 1400 crore, 1300 crores or 1400 crore, whatever number you want to take at that point in time, or a run rate of that number, you will see that my days start stabilizing better, and the ability to liquidate my working capital will be higher from two reasons. When your sales start picking up, your ability to liquidate inventory comes in, and two is also when there is a buoyancy in the demand, your ability to request your customer to pay on time is also higher, and which both will ensure that in next 18 to 24 months, we should be able to achieve that. That's the target, Ramesh, I would focus on going forward as well.
So if everything works well in terms of your own business plan, where do you see your debt, this gross debt figure, say, in the next 2 years?
So I don't want to give any guidance on those numbers, but I'll give you very simple one anecdotal evidence, and then probably you are better at math than me to really project it. But if you look at 22 versus 23, my working capital actually, when my sales picked up, my working capital days reduced by around about 40 to 50 days, from 290 to 240 days, 250 days. And that year, if you look at it, my operating cash flow from operations was around about 255 crores when I compare to the PAT of 170 crores. So I believe that the moment we start achieving the growth and the reduction in the working capital days, there will be a very strong conversion of EBITDA to operating cash flows. And for the first 1 to 2 years, we will have a stronger benefit from EBITDA to PAT, EBITDA to cash, and that's what you will see as we go forward. So, and what will happen is that I don't have right now any capex that has been planned. This cash will only convert into a reduction in the debt.
So if you look at the warrants issued to promoters, when do you expect the balance money to be paid? How much would that be, say, when everything is paid?
It's a 270 crores, which is expected in the first quarter of FY26. And that also will ensure that I have reduction in debt, because that primary usage of that is debt to a large extent.
Yeah. So let me squeeze in just two more thoughts. One is, your capacity has gone up from 27 to 30,000 as per the latest presentation. So where has the 3,000 ton expansion happened? In unit 5 and 6? In Sachin, where exactly has it happened?
So one in Sachin, one in Jagadia, and another one will come in Jagadia as we go.
Okay, it's all about 1,000 each, or?
Not because it will be 1,000, some 1,200 plus the balance will be in Jagadia.
Okay. And between domestic and exports, can you give us the split? What is domestic and how much is exports as of 9 months or 3Q?
It's broadly 50-50 for now.
Okay. So if you're looking at your margin profile, as you said, you're expecting some improvement based on your product mix, and there is an expectation of 35% growth. So what is the base FY25 revenue you are penciling in for that growth? And in terms of the overall portfolio margin, assuming that, you're able to convert the LOIs and the existing business, you'll be able to maintain the current year average trend in terms of margins?
So Ramesh, I don't want to give a very specific guidance for the numbers. Let me give you a directional one, which probably will help you in terms of estimating where we are looking at. One, I would continue to guide at 26 to 28% EBITDA margin, though I know there is an upward bias, but I would want to do that for two reasons. One, there will be a ramp up of new plants, which has its own implication in terms of overheads, at least in the initial when the ramp up starts happening. One. Two, when you have a newer product, it takes you a curve. There is always a curve that you hit the expected efficiency over one or two cycles of production. So that is the second point where I would like to keep it at 26 to 28%. And in terms of revenue, as I had also mentioned, that on a console basis, we should be flattish. In terms of standalone, we should be having a mid-teens kind of a degrowth is where I will put it at.
Mid-teens degrowth for the full year FY25, right?
On a standalone basis, yes.
Yeah. Okay, thank you very much. I'll join the queue and wish you all the best. Thank you.
Thank you. Thank you, Ramesh.
Thank you. Next question comes from the line of Rohit Nagraj from B&K Securities. Please go ahead.
Yeah, thanks for the opportunity. A couple of clarifications and a couple of questions. First, in terms of clarification, you mentioned that the total quantum of LOIs that is commercialized is 3,100 crores. So is it reflected in numbers, or these are the contracts which have been commercialized? How should we look at this particular number?
So you are right. You cannot say, you are right that I cannot say that 3,100 divided by 5, so 600 is a reflection in the revenue, or 6 and 500 is the reflection in the revenue. Answer is no, you are right. That's not the case. Because it's time to ramp up. But I can only say that this year we should be looking at around about 20 to 25% of my revenue coming from this LOIs and contracts.
This year means FY25?
FY25, I'm talking about FY25. FY26 should be a significantly higher number.
Right, got it. Second clarification again, the growth of 30-35% YOI, are we basing it on the standalone numbers or consolidated numbers for FY25?
Standalone.
Okay, fair enough. The couple of questions now, in terms of the gross margin expansion that we have seen. So historically also you've been telling that normally we have a back-to-back arrangement in terms of the raw materials as well as the contracts that are in place, and hence our gross margins or even EBITDA margins are largely secure. But a quantum jump suddenly in a particular quarter. So are there any other factors which have moved these gross margins significantly? Given that you are again, you've just alluded that on a sustainable basis, we still look at, say, 26-28%. So is there any one-off which has moved these gross margins during this quarter?
Rohit, really now it's more to do with the product, what product has contributed how much to my business. So this quarter has been where there is a product, where there are a couple of products which has higher gross margin, and that is the reason you would see it on a quarterly, because depending upon the schedules, few products go in a particular quarter versus the other products go in a different quarter. So on an annual basis, if you look at it, you will see me more stable. And also what I would encourage, and that's what I'm trying to share, that look at me more from an EBITDA than a gross margin level, because again, when you have a pass-through, I also not only have a pass-through of my raw material, I also have a pass-through of my overheads, my utilities, my every other cost. And that's where I try and look at a EBITDA number, which is a more reflective of that relationship. And as I was saying, that if there is a product which is a more complex product, then the complex product will have a lower gross margin, because there are multiple steps, and when multiple steps are to be executed, the overheads and the utilities would go higher. And if I keep my EBITDA margin to be constant, that means that I would have to expect a higher gross margin to compensate for the higher overheads that would be there. So I would put it only largely to that phenomenon than any other phenomenon.
Right. So just to summarize, probably if there is any change in a particular quarter, it will get even out during the course of say 4 quarters.
Exactly, and that's the reason. If you see, I have been very conscious of making those numbers, making that guidance on the numbers, and also in terms of if you look at my 9 months, they are more in line with rather than the reflection of the quarter.
Okay. And you also mentioned about one of the domestic MNCs going out of we have terminated the contract for Acton. So this is 15% of Actium revenues or total revenues?
Total.
Okay. And this is happened in FY25.
Huh? Sorry, I didn't hear you.
This has been taken effect from FY25. Is that the right way to look at it?
There was the process started from 24 and 25 you can see the full impact.
Fair enough. Just last question on the capex front. You said 200 crores of capex. However, the 670 crores probably still sitting at the CWIP level, and hopefully will get commercialized during this quarter. So how do we look at? So 670 plus 200 will be the total capitalization?
No. 670 will be the total capitalization. What he asked was the cash outflow for the capex of the year, and I said 200 is the capex for the year.
Fair enough.
So that includes 650. So totally you will see that 670 crores of gross block would be added by the year end.
Right. Got this. Thanks a lot and all this.
Thank you, Rohit.
Thank you. Next question comes from Ashwini Agarwal from Demeter Advisors LLP. Please go ahead.
Good evening, sir. Good set of numbers. Congratulations. A couple of clarifications to questions earlier asked. One is on the debt level. Did I hear the figure right that 1100 crores is your gross debt number as of 31st December 2024?
Yes.
So does that mean that it has come down by 170 crores? Because as of 30th September, this number was 1270 from what I can see.
Okay, just what you're saying, can I get it again, please?
Yeah, so basis what I can see, as of 30th September, your gross debt number was 1270 crores. And what you mentioned was that now your gross debt number as of 31st December is 1100. That would indicate 170 crore repayment. Is that right, or am I missing something?
When you have finished recording, you may hang up.
Oh, I stand corrected. The total number is around 1200 crores. You are right. I stand corrected on that.
1200 crores. So there's still a marginal decline from 1270 to 1200. Would that be
that's more to do with the capex repayment, the term loan repayments largely.
Okay. And so if you could just clarify that, again, I think Ankur had asked at the start of the conference call that the decline in operating expenses on a standalone basis that we see on page 8, which is quite substantial. You mentioned that it's mostly due to outsourcing costs, the contracts that you give out. Or is it that you capitalize some of the costs related to the capex? There is no capitalization. Is that a fair assumption to make?
Yeah, there is no capitalization. See, I'll tell you a very simple thing. Let's look at my revenue for the 6 months standalone last year, 9 months standalone last year.
Yeah.
If you look at it, there is a 30% right in terms of my sales, right?
Yeah.
Now, if you look at that, right, that also if you look at my employee benefit, let's say, the reduction is lower than that, right? Other expenses also, it is not as low as that. So largely, see, not all of these costs is a fixed cost, right? There is variable cost to it, especially the outsourcing or job work cost, right? And so that way you will see that you will be in the similar numbers. That's what I was trying to say. So honestly, there is no, if I were to put it simply, the variable part of the cost has been reduced, because of the volumes that has been produced and sold. And on the employee side, largely it is the ESOP cost which has really been the reason for that.
Perfect. Thank you. And so would you be able to read out the numbers for inventory and essentially inventory number as of 31st December? This number was 1272 crores as of 30th December.
I would excuse myself from this because we don't list out those numbers for the third quarter. Because then again I would have to report out all the other numbers, because then only my balance sheet would be fairly looked at. So I would say it's the similar range is where you can take it for now, please.
Oh, thank you so much.
I hope you appreciate. Apologies if I have not been more helpful than this, but you can take my words on that we are fairly stable on those numbers right now, on an absolute term. Right?
That's fine. Thank you, sir. All the best. Thanks.
Thank you.
Thank you. Next question comes from the line of Raja Kumar Vaidyanathan from RK Investments. Please go ahead.
Yeah, good afternoon. Thanks for the opportunity. Am I audible?
Your line is a bit cracking. If you can be a bit.
Yeah, can you hear me now?
Yeah, that's far better.
Yeah, thank you. Sir, so my question is on the inventory. Sorry to labor on that. So if I see your September inventory was 1,270 crores, and if I see your December number, the changes in inventory is almost 120 crores negative is there, which means you have added further 120 crores inventory. So it's about 1,400 crores of inventory roughly you should have as of December. So, and I also look at your material cost to sales is about 40% on a consolidated basis. So which means you are roughly carrying almost, inventory to serve almost 3,400 crores worth of revenue, which is almost like 2 years of revenue. So I just wanted to, if you could just give some color why we are adding this material. Is it because is there a lot of lead time is involved in locating this material, or is it a long production cycle? If you could just enlighten us, it would be really helpful.
Sure. So I would not speak on the specific numbers that you have derived, and I will leave it to your judgment on that. But let me answer the question and say that why are we having such a high inventory, be it 1,000 crores or 1,100 or whatever number we derive at. Let me put it very simply. If you look at large part of my that inventory will come from finished good and WIP and not of RM. RM will be 15 to 20%, 20 plus or minus 5% of my total inventory holding. Now, why do we need to hold this inventory? On a structural basis, I'll answer first, and then I'll answer why it is higher than the structural basis as well. So on a structural basis, if you really look at it, I am one of the primary or single supplier to my customer. And when I am that, I need to hold a particular level of finished WIP. What is WIP to me is basically a product which is here ready to be dispatched, but I would want to keep it not yet finished, because then where the aging comes into play, I will keep it one step before, or I will hold the distillation process back so that the age of the product is not starting. So that's the reason you see WIP and finished good. And hence, if you have to see me, you have to see me as a percentage of sales, inventory as a percentage of sales rather than percentage of COGS, which you are seeing me at right now. So that's one that I would say. Having said that, even after assume of that numbers, whatever, I would say that my steady state sustainable business model should have been around 180 to 200 days of those numbers. And if you look at me at that numbers, you will see that my ROCs, my turns, everything will play out. However, today I am higher than that. Even if you look at the September numbers, I am significantly higher than that. And for that. When I exited 23, I was at a run rate of around, I was on a turnover of 1,300 crore and a run rate of 14 to 1,500 crores of revenue on a run rate basis. And I was expecting a revenue growth in the next year as well. Now, when you are planning with that kind of a revenue growth, the production plans are accordingly. And when instead of that, we had a degrowth for 18 months. If you really look at it, for the 18 months from then on, we have a degrowth that we saw. So I had a double whammy where I had a production and hence the inventory accumulation, but my my sales did not happen. So my numerator has dropped. Today you will see me at a TTM of a 900 versus what had there been a growth, I would have been at TTM of 1500 to 1600 crores at that point in time. Because on 13, even if I put a 20 to 25% growth, I would be at a 15 to 1600. All my numbers would look more reasonable. And two, also what happens is that when you produce but you are not able to sell, that accumulates into your inventory, and so inventory expanded on an absolute number also, which is what you would have seen me from 23 to 24 September numbers which were reported. If you look at it, we have expanded by around about 200 to 250 odd crores of inventory. So that both put together has really expanded the situation. Had there not been that, I would have achieved that number. And if you look at the trajectory from 22 to 23, that trajectory was there. So 290 had gone to 250, and one more year of growth where I would have been able to liquidate my working capital and also increase my revenue, I would have been at a 220 to 200 days. That was what was projected. So I appreciate this is a matter of concern for each of us. The only thing that I can say is the reflective will be when I get my sales growth back, because sales is there but it's not sufficient enough. So when the sales growth is back, we would be able to see the numbers which are more amenable and more sustainable to the business model that we have. I hope I have helped you on that.
Yeah, this is helpful, sir. And any comment on the material cost percentage to sales? It's about 40%. So you are roughly having 2 years of inventory. So if you could...
That's what I'm saying. It is not the way, I would not see it that way, my friend, for a very simple reason that 80% of my working capital is a finished good to working capital in progress. So then it is not COGS, it is sales. And so you have to see me through sales rather than through COGS. Because when I sell, it's a 9-month sales number that is there, 12 months that is there. The moment I start selling, it comes to that number. And that's the reason this and look at my numbers, because I've declared my working capital work in progress numbers, or my finished good and my RN numbers, and you will see those reflections. And that's where I'm coming and saying that look at me from the sales rather than from the COGS.
Okay, this is helpful. Sir, just to extend the question, just one more question. I'm sorry, I'm just collecting my thoughts. Sorry.
No problem. Please take it.
I'm sorry, I'll just get back, sir.
No problem. You please join in as and when you want. Happy to answer you.
I'll fall back in the queue.
No problem. Thank you.
Thank you. Next question comes from the line of Tushar Ragate from Kamaya Wealth Management. Please go ahead.
Yeah, good afternoon, sir. Thank you for the opportunity and congratulations for a great set of numbers. Again, sir, the question is on the working capital. From the last 5 years, I could see your working cap, your inventory as a percentage of sales. From 40% it has been to 72%. Firstly, I would just like to know what would be the average of that. Is it 60% or just a random number I'm saying? So accordingly, your take on that first.
Okay. Sustainably, eventually my number should be 50% plus or minus 5%.
58% you are saying, right?
50.
Okay. So that means you're
sustainably 50% plus or minus 5% depending upon the business cycle, depending upon the number of molecules that I launch, depending upon the contracts that I get into. But you should sustainably see me at that level.
Got it. So that means more or less 2,300 crore of sales considering the inventory you are carrying, right?
I would not put the exact number, but it will be two things, please appreciate. I will put it simply, because this number, when I sell, it sells completely, right? It is a one-time sale. It is not two-time sale, because let's say I have 1,000 crores of inventory, right? If I sell 200 crores is reduced, right? Because that is ready to be sold, and I'll go to 800. Now, Right. So what I'm saying is please appreciate as simple as that eventually, because I said that there are two parts to my working capital. One is a sustained working capital which will be required for my business to sustain. Okay. And two is there is an additional working capital which is there because of the situation that I mentioned in the earlier question. So if you knock these two up, you should see me like let's say next year. So that's where I'm saying that by 18 to 24 months, I should end up with the numbers that we have talked about, which is where I should be achieving 180 to 200 days of my working capital. Sales as my working capital, and it will be a combination of two things. One is liquidation of some part of the working capital, and two is increase in the sales that I would expect. So combination of these two will come to a more sustainable number rather than only one.
Got it, sir. Just again one question, sir, on the trade receivable part. So like 5 year CAGR of the sales is 24%, but the trade receivable is growing at 37%. Just wanted your take on that.
So if you look at 2 years back, and if you look at my growth, my CAGR of sales and CAGR of receivables, only in the last 4 to 6 quarters that number of receivables have expanded.
Yes.
And that's largely because of when the markets are slow, you would tend to give an additional credit, which I have given, and that is the reflection. I can give you one simple example. One of the largest agchem company in the world, they requested us that we were due to pay you in November, but as my year is ending, and this is a slow. I'm reading between the lines that this year has been slow year, and my year is ending. Why don't I request you to pay you in January, not in December, in November? And for that, if there is any cost, I'm willing to pay the cost. Now, that is a customer who has been with us for last 10 years or more. We are doing multiple products with them. We are doing multiple new projects with them. I don't see any request like that. And mind you, they are. So I appreciate that it has expanded, but you will also to see from the reflection of the market realities where the markets have really been pretty weak for my customers, and I have to stand by them, which is what I have done on the receivable side.
Got it, sir. And sir, your non-agro
Sorry to interrupt. Tushar sir, may we request to return to the question queue for follow-up question, please?
No, it's okay. Let him ask this question and then he can. It's okay.
Okay, sir. Thanks for that. Sir, just wanted to know your non-agro business. Like due to that, do you see any working capital relaxation going forward?
Yeah, you would see. See, every business will have its own dynamics. So in some businesses, you will see that the inventory is higher. In pharma, if you look at it, because large part of my pharma business is Indian pharma business. When you see receivable days will be higher because India tends to be longer on the payment cycle side, and also they tend to delay from the promised ones. So when you see my receivable days expanding, you will also have the reflection of that. But on a total basis, on the other side, pharma will have a lesser inventory requirement because again I will have that kind of. So overall, you will see it will be even Steven, but yes, there will be nuances to each of these segments.
Got it. Got it. That was really helpful. Thank you.
Thank you.
Thank you. Next question comes from the line of S. Ramesh from Nirmal Bang Equities. Please go ahead.
Thank you for the follow-up question. There are two parts. One is, if you look at the kind of indication you gave on the mid-teens kind of decline for full year, it suggests that you have to grow your fourth quarter revenue by about 15%. So, because last year you did about 308 crores. So what is the visibility you have to, surpass last year's 4Q revenue as we speak? And secondly, if you look at the mapping of your growth drivers on, I think, slide 17, you have given the 3 growth drivers: polymer, pharma, LOIs, and then fluorination. So can you strip out any overlaps and say, what percentage of your growth will come in each of these areas? Because there could be some, common products across the 3 categories. So if you can split these 3 drivers into independent categories of growth to avoid the overlapping and duplication, that will be very helpful.
Oh, sure. So let me answer that first question. What you are saying about what you have deduced in terms of the indication, it's fairly the right reflection, and I believe why we believe that we will be able to deliver is a very simple thing. That if you look at it, as I said, I have a very high visibility coming from my customers' demand. It's coming back, and I am seeing that the customers have requested for those volumes, and hence that number will be the number that is there. And if you see last year, whatever we did was also lower than what we did in 23. So is it that this is the numbers which we have not delivered? Answer is that we have delivered these numbers. We believe that the numbers that we have been seeing in terms of whatever demand that we have seen from the customers, whatever the orders are there, we feel far more comfortable. And also please appreciate, now is the new year for my customers, large part of my customers. And they have a more buoyancy in terms of their ability to give me a more firm demand, which we are seeing now. So all in all, pharma polymer continues to give me the growth, and it can coming back will give me this growth.
Yeah. On the second question on the growth drivers, you can strip off the.
So next time onwards, I'll try and see how we can share that with you, because see, it is very difficult to do ceteris paribus on all the three parameters. But we'll try and see how we can present it better for you.
Yeah, that would be very useful. And thank you very much, and wish you all the best. Thanks.
Thank you.
Thank you. Ladies and gentlemen, we will take that as a last question for today. I now hand the conference over to Mr. Vishal Thakkar for closing comments.
Thank you everyone for your active participation this time. Definitely it was very, very helpful and exciting. We hope that we have been able to answer most of your queries. I also apologize if I have not been able to give more specific answers because of the constraints that we are as a listed company to not give a very specific guidance. So, any of the questions, or there are some questions in this call, please feel free to reach out to our IR partner E&Y, and we will be happy to take it offline. Thank you very much.
Thank you. On behalf of Anupam Rasayan India Limited, that concludes this conference. Thank you for joining us. You may now disconnect your lines.